So you think the housing market's headed for a nosedive. Hold that thought because the numbers tell a different story. Again. In today's video, we're unraveling the truth behind the real estate buzzwords. Crash, rate drop, values jump, values decline, and the looming recession. We're going to dive into why home values are jumping despite the economic doomsday predictions and how recent shifts in mortgage rates are reshaping the market landscape. But there's more beneath the surface that we need to uncover together. So let's take a look at what's happening and what's really driving all of this. Whether you're an investor, a homeowner, or you're looking to buy, understanding these dynamics is crucial for making informed decisions. You want to do your due diligence, and there's a ton to consider right now. The information is flooding in. Welcome back to my channel. My name's Darin Hunter. We're going to decode the real estate and mortgage market for you today. We're diving into the latest appreciation numbers from the major real estate tracking firms like Case-Shiller, Zillow, Black Knight, FHFA. It's a whirlwind out there with the appreciation rates climbing, mortgage rates dropping, and everyone talking about a potential recession. But what's really happening out there? Let's break it down. If you're keen on keeping up with real estate trends, don't forget to hit the subscribe button and let's jump right into this. First things first, let's look at the latest numbers. Almost all major real estate tracking firms, Case-Shiller, FHFA, CoreLogic, Black Knight, with Zillow being the notable exception, report home values at record highs. Year-over-year appreciation is sitting between 6 and 8%. That's huge, especially considering mortgage rates are in the 7s. This is fact. The average home is up. And I get it, there are some areas around the country that are experiencing some drops in values, but again, the average home is up 6 to 8%, and there's no arguing this. If you've been waiting on the market to crash, you've missed out. How long have you actually been sitting on the sidelines because your brother-in-law told you to hang tight or you listened to the media talk about the pending crash? Well, it's been years now. Let's look at an example. Take a median home price of around $430,000, for instance. A 6% appreciation translates to $25,800 in equity that could have been yours in year one or over $53,000 had you bought 2 years ago. Remember, that's compounding. Additionally, you would have paid down your mortgage over $8,500 in that 2 years. So in 2 years, you would have had netted gain of about $60,000 on your asset side of your balance sheet. Let's tackle interest rates. They hit 8% in October, raising questions about the market's future. No doubt about it. To play both sides, numbers from CoreLogic, Case-Shiller, and the rest are numbers through September. So we'll see exactly how that 8% rates affected values. I would not be surprised to see a negative number month over month, or at least a flat number month over month. While the increase in rates to 8% is a concern, it's unlikely to trigger an 8% drop in home values or any real significant drop for that matter. Remember, real estate markets are vary greatly by location. Despite some areas experiencing value dips, the overall market hasn't experienced a crash in any form or fashion. Post-October 16th, when mortgage rates peaked, we've seen a fairly significant reduction in rates. And trust me, I get it. Dropping from 8% down to 7%-ish is not super sexy, but it's a huge drop in a short amount of time. This includes a significant increase in the price of mortgage-backed securities, which drives our mortgage rates, right? Additionally, there has been a shift in the Fed's stance on future rate hikes. If you look at the CME Fed Watch tool, the probability of rate cuts coming down the road are increasing and slightly more probable in March of 2024. These changes could potentially cushion the market against the harsh impacts anticipated by many. The trend is clear. Rates are trending down. It appears this will continue. All right, quick reminder, if you're enjoying this deep dive and want more content, do me a favor, hit the subscribe button. I certainly appreciate it, and the support means a ton. Let's talk about the broader economy for a second. The economic landscape is also a critical piece of the puzzle, clearly. Despite a thriving GDP growth rate of over 5%, there are concerns about sustainability given the government's spending patterns and the potential debt increase that will incur due to these spending patterns. The bond market is reacting interestingly, with a decrease in the yield on the long-term bonds despite an expected increase in Treasury issuance. Everyone knows that the U.S. government is going to continue its spending like a drunken sailor. There's no matter what side of the fence you are on, I think it's all clear, we can agree that it's going to continue. How do you think the government pays for all this? They have to finance it in the form of U.S. treasuries. So the major players out there know the supply of U.S. long-term treasuries is going to be substantial. And yet the 10-year bond is absolutely plummeting. This means that the market is okay with longer-term bonds because they are evaluating the market and see something they don't necessarily like coming down the pike. They are willing to tie up their money for a longer duration with a mediocre yield or return to keep their money safe. This trend suggests that the market is preparing for a possible recession. In real estate, this could mean continued demand due to lower borrowing costs, as long as the job market remains stable, of course. If we see a significant increase in unemployment causing folks into forced sale situations, aka a foreclosure or selling because they're desperate, then yes, I will absolutely agree that it could put downward pressure on home values. But until we see any sort of significant increase in unemployment, there are no signs of housing values starting to decrease over the average. Again, I fully understand that values are local and real estate is local, but overall, the average home continues to see an increase and will continue to see that increase for some time. So looking ahead, the possibility of rate cuts and overall lowering of borrowing costs could bring more buyers into the market. For every 1% drop in mortgage rates, you could see a potentially add 5 million buyers supporting home values even further. However, it's vital to keep an eye on the bond market. We were seeing the yield curve starting to flatten out with the long end of the curve increasing. That period in October had the 10-year Treasury up to 5%, and now it's reversed. Remember, an inverted yield curve is a major sign that a recession is on the horizon. A recession typically leads to lower borrowing costs, which in turn can support the real estate market due to, again, lower borrowing costs. Take a look at the chart. With the exception of one recession, we have seen an increase in home values through every U.S. recession. I know the one exception really triggers a lot of folks out there, so let's remind everybody that in 2008, there was an enormous oversupply of homes and very little demand. The demographics have changed significantly in the U.S. We've had huge population growth over the last 15 years. So now we're dealing with a high demand, very little supply. So what's the key takeaway? Stay informed. Consider both the current trends, future predictors, and the past decisions that were made in the real estate market. All right, to wrap it up, the real estate market continues to defy expectations of all the talking heads in the media, showing resilience amidst the economic uncertainties and fluctuating interest rate. While there's no doubt some areas are experiencing some drops in value, the overall market remains strong. Remember, real estate investments are long-term plays. Keeping an eye on those trends and understanding the underlying factors can significantly impact your real estate decision. So thank you for watching, and remember, please like, subscribe, share the video for more insight, stay informed, and navigate the market with confidence. My name is Darin Hunter. That's another guaranteed message, and we'll see you on the next video.